Hey there, it's Mike Langford. Welcome to the Augmented Advisor Podcast, brought to you by Blue Leaf. This week on the show, John Prendergast and I are joined by Kieran Bol, Head of Platform Operations at PriceMetrix by McKinsey. Now, a little warning before we get started. Kieran is, well, he's Canadian, so there's going to be some comedy in this episode. I mean, you just can't help it when you're hanging out with your Canadian friends to bring the funny. Seriously, though, John and I wanted to have Kieran on the show to talk about the state of North American retail wealth management. And as it turns out, Kieran and his team wrote a report on the topic. In fact, earlier this year, he and his team at McKinsey published the firm's 10th annual report on this topic. So they've been deep diving on this topic for quite a while now, so they know their stuff. You're going to want to buckle up for this one because there's going to be a lot of high-end insights coming at you in this episode. Before we get started, please take a moment to subscribe to the podcast on Apple Podcasts, Spotify, Google, Amazon, the YouTubes, or wherever you like to get your podcast jam on. And if you have a question or suggestion for a topic or a guest on the show, please feel free to reach out to Blue Leaf via blueleaf.com or hit us up on the socials. Blue Leaf, John and I are all active on LinkedIn and Twitter, and we are super easy to find. Okay, let's get to our conversation with Kieran Bol. Well, Kieran Bol, welcome to the Augmented Advisor Podcast. So fantastic to have you all the way from the Great White North in Canada. Thanks for joining us, buddy.
Happy to be here. Thanks for having me.
Very welcome. This is fantastic. So for those who are listening and or watching, we got things going today. We're shooting a breeze about a show called Letterkenny, which is based in Canada. So if you're looking for a good laugh, make sure you check that out, because if in the event that we drop any Letterkenny isms in this show, you'll kind of know where we're going with it.
It's the most Canadian show you'll ever watch.
It very much is. And look, for a lot of Americans, we're watching Schitt's Creek and fell in love with that show, Canadian produced, right? So it was a huge, huge hit here in the States. So if you liked Schitt's Creek, you'll definitely like Letterkenny, but be prepared. It's like it's like a little more on steroids in the way that the humor comes at you. So, well, let's start the conversation with what brought us together. So John, as he likes to do, is constantly consuming all sorts of great content related to the financial advisory and wealth management space. And he comes across this article.
I do.
He does. He does. And he comes across this article about the latest report published by the PriceMetrix, a McKinsey company team, called the State of North American Retail Wealth Management. And it's actually the 10th annual report. Mm-hmm. And so I thought maybe we could start with a quick overview of how that report was compiled, because that kind of sets the stage, right, for like what we're going to talk about today. So is the report based on surveys, public filings from wealth management firms, a series of interviews, or kind of all of the above, or some other methodology?
Well, it's actually none of the above.
Okay.
It really is based on our data set. We have on our platform about 24 firms, about 70,000 advisors, a lot of clients. And we have this, really granular data set so we can provide benchmarks to our clients, but it also means that we can do things like look at industry trends, right? Look at pricing, look at growth. And this is real data. This is actually what advisors are doing. It's not, what Bob and Sally down the hall say they're pricing or say they're growing, right? It's actually what they're doing. We find that really powerful as a bit of a difference. So we can take a look at some of those high level trends, and we publish them once a year in these types of white papers.
The reason why I love that question, or to make sure we cover this, is I think we've all seen these reports that are published by one research organization or another. And then you go down to the methodology side. Like, we surveyed 362 financial advisory firms, and here's what we found. You're like, 362? Like, maybe that's statistically relevant on something, from I'm not the best statistician, but it always feels a little weak, right? That you didn't really dig into real data, and it's also self-reporting, which has some problems to it. So like, I love the fact that you're pulling real data, and you said 70,000 advisors.
That's right. Yeah. And again, there's always a gap between what people say they price, even if you ask them, or even if they try to truthfully remember and what they're actually doing. So that's how we can get to that kind of like trying to get to the truth, right? Trying to get to that core nugget of what's actually going on in the industry right now.
It's really about behavior at the end of the day, right? Data's people too, a friend of mine used to say, and because it represents what real people are actually doing. And when I first read the report, I was struck that it was bigger than I had expected, right? And in a lot of ways, it encapsulated the story of 2020. And I think the phrase that I most remember from the report was a year of remarkable resiliency. So would you mind painting us a picture of what 2020 looked like and that resiliency that you saw?
Yeah. So let's all go back in the time machine a little bit to this time last year or a little before that. 2020 had a lot of challenges. That's understating it, right? If you remember the beginning of it, there was a lot of uncertainty. The markets were dropping. The economy was shutting down. There was runs on flour and toilet paper, at least where I was. It was just a lot of like batten down the hatches. The storm's coming. And I think it was reasonable, and I was certainly thinking about it as, okay, well, maybe 2020 is just going to be a mulligan. Like we're going to see some bad behavior, like you're saying, and is what it is. And that's not really what happened, right? There was a bit more of a V kind of rebound, right? A little bit faster than we thought. Advisor assets actually increased in the year, which is remarkable. Revenues were totally fine. Pricing, or at least this fee pricing actually was relatively stable. So, really felt like, oh, okay, advisors weathered the storm. They didn't just accept it and then, close up shop, move on. There was really a lot of resilience. And I think broadening it out, I think there's a lot of resilience, globally.
Yeah. I think it's interesting because that V shape was really pronounced, right? If you remember, and I'm sure our listeners really remember, that first quarter after the big market correction, right? That first market correction, about, what was it, about 20% or so. That really hit fee revenue. But what you're saying is that the rebound not only came back, but was enough growth that it kind of offset that, because revenues held. So that's pretty remarkable.
Yeah. And I guess, for all the listeners, when we talk about fee, it's, we just charge a percent of assets. So it's really linked, right, to the assets in the market. And that held, when the rebound happened, it held. But even more so when we look at a little bit on that new account pricing, that new client that came in 2020, you might expect, oh, okay, well, maybe there'll be a bit of a discount there. And not really. Didn't really see that. A lot of advisors were able to defend their value. So again, there's some resiliency there that says up, down, I know what my value is as a financial advisors, and I can articulate that.
And when you're talking about that pricing, what are we talking about in terms of averages? And obviously we'll link to the article for our listeners and viewers. But what are we talking about for average fee pricing in 2020?
Yeah, so for like your typical, let's call it $1 million client, and for your typical fee platform, it is about 1%. I think that's where new fee accounts are right now. And fee is an interesting state where it's I think it really is stabilizing. Previous 5 years, there was a bit of a decline, some pricing pressure. But I see going forward, like that was a bit of some transition period as fee was ramping up, as advisors getting more comfortable with fee and with that kind of relationship value. I think the majority of advisors got that now. And I think looking forward, I say something like around that 1% range for that $1 million client, I think going pretty steady.
And it feels like something people have gotten pretty comfortable with. I think as financial consumers, that 1% of AUM kind of feels about right, because it's like, okay, yes, I understand, like, up and down markets, sometimes I'm going to pay more when the markets are up. When it's down, I'm going to still be paying a fee. But your fee goes down with the market. So that has kind of resonated with folks, I think. So people are getting really comfortable with that, and they understand that they're getting more, as you mentioned, the value for it. It's not you're not just paying for like an investment product. You're actually paying for advice and guidance. One thing that jumped out to me as I was looking at the report was this continuation of asset growth and revenue growth. So you mentioned, hey, and we talked about the V-shaped recovery was very quick and very pronounced. So we really in 2020, we didn't see a down year that everybody thought was going to happen. We thought it was going to be financial bedlam. So that, I think, caught a lot of people by surprise. But you looked and you said, listen, the fee revenue growth and the asset growth really was driven by market performance. It wasn't, unfortunately, driven by people bringing on a lot of new clients. And that growth rate, as you outlined in the report, is pretty stagnant. So, which basically means, as a friend of mine here in Austin who runs a wealth management firm says, we've been getting a lot of free money in this really long bull market since '09, right? It's just free money. Every year you're making more money than you made last year, and you didn't really do much to make that extra money. But at some point in time, that's got to end, right? That we're going to have a down market, or we're going to have a sideways market, or whatever. Should advisors and firms be alarmed by this trend of not bringing on new clients, of just growing with the market? What might we expect, if this flow of free money ends?
I think that advisors and firms should at least be concerned. I mean, like, let's call a fork a fork. I mean, we're in the financial advisor space. You're going to have some effect on the market, right? Like the market goes up, this is going to be easier when the market goes down or sideways.
Yeah.
But I'm not sure if everyone understands how much of an effect it is. And, that's what we call out in this paper. In the last 5 years, 75% of the asset growth of advisors is just market performance, right? We saw 8% year-over-year growth year-over-year, 6% is market, right? So 3/4, the majority of growth is just the market floating your boat, right? So what's left over after that? It's something in the order of 1 to 2% of that, trying to get that extra new client, after you subtract the clients that do naturally leave, and yes, people do leave. That's not a lot of growth, right? And that's not even accounting for any inflation, right? That's just 2%. The market goes sideways. That's concerning, right? How do you continue to grow no matter what the market condition? And especially considering the last couple of years has been really kind, right, to this industry. You can hope that the next couple of years will be just as kind, but maybe we should plan for something a little bit different.
And, based on the report, some of these headwinds to growth are really structural, right? I'd love to dig in on a few of them. So one thing you already mentioned is this fee-based pricing and the declines. And, I'd like to talk a little bit about the shape of that and sort of the declines that you've seen, and how it's slowing, and get a sense in terms of basis points, really what the magnitude of that is. Because, my observation is that's part of a very long-term trend, maybe 30, 40 years, where you see that declining. And if that trend's starting to slow, that's actually could be fantastic news.
Yeah, I mean, you're right. Like any industry, this industry is in constant transition, constant evolution. When you think about pricing, and pricing is kind of where do you get your value from, right? 20 years ago, 30 years ago, it was, I'm going to give you access to markets. Like, I'm a financial advisor. You want to trade? Come to me first, right? And then, the internet disrupted that. Okay, never mind. Portfolio allocation, that's what I do. And that's starting to go away. And even market performance, I think that's more and more starting to be removed. And what advisors have realized is their value is in that relationship management, right? It's in that planning, it's in that trust of like looking at client eye to eye, saying, don't worry, I'm going to be able to manage your money so that you can retire, in the level of comfort that you want, right? It's that assurance, like nothing certain, but it's an assurance that I'm taking care of it. You're taking care of the birthdays and the groceries and university graduations, but I'll take care of the rest of the planning behind the scenes, right? And yes, pricing is stabilizing right now. Obviously, there's a large variation in price. What we've seen the last 5 years is this decrease in price. And off the top of my head, I think it's 5, 10 basis points decrease. And one thing to note is it's not everyone. Okay, well, when we took a look at, is everyone just lowering price a little bit? Actually, no. The majority of advisors are actually maintaining their price. About 70% were actually flat versus what they even charged themselves previously. There was a third of advisors that actually really decreasing in price, like 20 basis points off their previous last year's pricing. There's massive drops, and that was over the last especially like 16, 17, 18. I think a lot of that was in confidence. Like I think there was these emergence of robos, of new client demands, and some advisors were really like, oh, I don't even know what my value proposition anymore. All these new entrants are coming in. I'm not sure, can I articulate my value? So there's a group of advisors that really said, okay, I should discount, I should go more towards Schwab. And it really doesn't work that way. Like that's not what clients are looking for. They're not looking for price. Like it needs to be reasonable, but then you take it off the table, then you talk about trust and transparency. Not every advisor got that. And I think they were new to fee, and that really kind of decreased the overall. But again, it wasn't everybody. And now we see that I think the advisors have been inoculated, to borrow a word, around, okay, I now know what this means. I now know what fee is. It's about the relationship. It's about that trust and that planning and that communication. That's where my value is. Okay, I understand that now. And I'm going to price accordingly going forward.
So that's really interesting. So you're saying that within a band, that pricing's pretty inelastic in terms of demand. That the demand doesn't vary that much within a certain band.
Yeah. We've had some studies saying, looking at clients, asking clients like, hey, why did you select your advisor? And also some studies about why did you fire your advisor? And number one for hiring is things like expertise, qualifications, trust. Way down on the list is price. And on the flip side, like why'd you fire your advisor? Number one, advisor retired. Number two, I moved. Like it's these things where, whoops, I can't do this anymore because of other reasons. And again, lower down is price. It's not, price reasonably so you can take it off the table and then talk about the trust and expertise that you have.
Interesting. And does your data suggest that some of those folks, that the substantial decline might have been substantially overpriced? The sort of the evaporation of the 200 basis points and sort of people trying to get that kind of rate.
Right. No, it was everybody. It was remarkable. It's really an advisor mindset thing. And I think the emergence of robos really was, if anything, just an attack on advisor confidence. It wasn't really an attack on the industry, but it was on advisors' ability to think about, where does my value come from? And I never really had to think about this before. And everyone, I think maybe especially those advisors that are newer to fee and really were making that transition. I mean, think about 5 years ago, like fee was not where it was now, right? It was still a lot of brokerage. So if you're new to fee, oh God, E-Trade, Schwab is going to zero. Okay, hold on a second. I guess I'll price something like that too, right?
Yeah, it's great insight. And it sounds like in some ways robos did advisors and the industry a favor, getting them to focus on their value proposition, which I think is what marketing folks have been suggesting for a long time.
Yeah, it's sharpened the value. Yes, it is, of course, like the cloud with the silver lining, right? It sharpened the value that advisors had to suggest. I think it also, it was disrupting a client segment that advisors, I think the knee-jerk reaction is, oh God, oh God, oh God. But those clients that typically going towards direct, they're a little bit smaller, a little bit younger, they don't have that financial complexity. You have to ask yourself, do you really, can you really articulate your value to that client when they're, it's not they don't need a navigator, professional navigator like that, right? So, oh, maybe that's not the client I'm want to look for. Maybe it's okay to actually move them to a different channel so I can focus on the clients that really do resonate with my value, really do need that level of planning.
Another area you talked about in this report, which I thought was really smart as a structural challenge to growth, was the average age of clients.
Mm-hmm.
Can you talk a little bit about what is the average age of clients and sort of how that holds growth back?
Yeah, no, I find that really fascinating. So, think about the average age of a client. Maybe the advisors that are listening, think about, from your book, like what would that be? For the industry, it's about 65 years old. Okay. So that means the typical client in this industry is retired, right? They're looking for conservative investments, they're probably making withdrawals, right? And well, if you're an advisor and your book is majority these low growth kind of clients, well, that means that your book is a low growth kind of business, right? When we take a look at the typical, let's say, 80-year-old, I think they grow around 5% per year, and the majority of that is the market, right? So there's been some very kind growth, great. When we look at a 50-year-old, someone who's in prime earning years, they are looking for retirement, they are making deposits, they're looking for aggressive growth, they want some planning. Those types of clients, they're growing around, I think it was 12%. 12% versus 5%. Like that's a huge difference.
Wow.
And those are clients that once you have that business and of course you maintain it, but that just grows intrinsically. They're just making deposits and growing your business kind of on your behalf, right? You don't have to manage that growth. You don't have to hunt and, beat the bushes for new clients. That just grows, we call it intrinsically. And I don't think a lot of advisors are thinking about the demographics. They think they're just thinking about the numbers of how much assets do you have? Okay, yeah, you're in. I would challenge the advisor to say, think about the growth rates you might expect, and think about that slightly younger client that maybe doesn't have the assets you want, but has the growth that's really vital. And maybe you can, diversify away a little bit from those older clients that have a lot of assets but don't have any growth associated with them.
What's interesting about that is I've seen somewhere, I haven't seen official data to back it up, but I've seen this used a lot when we talk about this concept is, the average age of your client is within 5 years of your age as an advisor, right? So you go out and you try, you're going to get some older, obviously, and you're going to get some younger, but as you age as an advisor, and the average age of an advisor now is around 60, as you mentioned, the average client is around 65, it seems to make sense. And I think one of the other things we talked about at the beginning of this conversation is there's a lot of comfort that happens. Like an advisor grows a business, they get it to a certain AUM, they get a certain client level, and oh man, it's been an easy ride. All this free money all this time, so I don't have to go out and sell and bring on new clients and so forth. And kind of what you and John are alluding to here is there's a lot of risk baked into that behavior and that comfort level, because in the event that the market kind of cools off or goes negative for a little while, you're going to experience potentially some negative growth, especially because your clients are in redemption period, right?
Mm-hmm, mm-hmm. I mean, you were talking about, the life stage, you have of advisors, and we talk about that as well. Some advisors kind of have enough, like, oh, I'm big enough, and maybe to reach that next stage requires a little bit of effort. I don't know. I like to golf on my Fridays and Mondays. Do I really need to do this next? But you're absolutely right. Client age and advisor age are usually similar because how'd you start, right? How'd you start in your business? You called your friends, right?
Mm-hmm.
That's your warm market, and then you get referrals from your friends, and then et cetera, right? So it's not impossible, but there's obviously some challenges to get to, like, what's the next generation, like to land that client that is 20 years different from you.
When you think about it, this could have a profound impact on the value of the practice.
Yes.
Right. And if you think about an advisor who doesn't necessarily want to grow, but maybe wants to retire comfortably, they may want to reconsider this whole growth question. if they can imagine pricing an annuity at 5% versus pricing the same annuity at 12%, well, you kind of
Mhm.
see, that 12% annuity is worth a whole lot more, right? And that's essentially what the business value is. So it's a really fascinating concept. And Mike, I think we could do a whole show on that one.
Yeah, exactly. It's true though. I mean, when you think about somebody buying your business, right? If you're going to acquire another business, what are you buying, especially in this space? You're buying a stream of cash flows, right? Like you said, it's an annuity.
Yep.
And is that cash flow is going to continue to grow? How strong is it? How stable is it, right? Are we going to see it taper off, or is there a lot of risk baked into there? Like what if the client base starts passing away because it's old, right? Even if there's just a
Yeah.
ton of money, right? So that's, this pandemic that we're coming out of now, to me, and I've talked about this in other arenas, should shine a really strong light on your client roster. And if you're at a firm that has multi advisors, also the ages and health risks associated with your advisor population as well, right? I mean, this pandemic was brutal to those over 65, and if they're over 70, which is not uncommon, right?
No.
In this client base and so forth. Man, oh man, that's a scary proposition that you could have lost a lot of value really quickly due to this type of thing. So it does bode well for those who re-examine the demographics of their client roster, as you mentioned.
Yeah, absolutely. And yeah, it's something definitely to think about when you're purchasing a book. Just not just, hey, what's revenue, but oh, what's your typical advisor age? Or, and
Mm.
are their assets? We're not saying, go after that 35-year-old. It's just not something that's possible. Like I'm not saying I know there's a lot of news that says like the millennials are the new source of wealth. Like, are they though? Like there's just not a lot of complexity there. Like I would describe it as complexity.
Yeah.
Um, you know,
$10,000 at a time, the new
yeah,
source of wealth.
and every dollar is important. That's totally fair. But
Yeah.
once you get a more complicated life with with retirement and with kids, and should I purchase a house? Should I rent or own a car, et cetera, et cetera? Get much more complicated. So I'm saying a young age is like 50 in this industry. That's young, right?
Yeah.
So let's move the needle, bend a little bit towards that.
Yeah. Yeah. Well, if you're in a business where you earn AUM, a fee on AUM, you got to have the A, right?
Yeah.
Right? You've got to have the assets under management in order to earn a fee, because 1% on $1 million is $10,000 of revenue a year. You're going to need a lot of those in order to make a living, right? And so if you're bringing on, as John, you guys said, $10,000 a client at a time, that's kind of really a lot of work. You're going to need a lot of clients to make a living.
Now, for all of those folks in the audience who say, wait a minute, my business model is different, and we get that, and we're going to do another show on that. And I think we've talked to Greg Brown at NAPFA about these different models that reach these different demographics. But bear in mind, we're talking about this AUM model here. So we'll get to your issue on another show, I promise.
That's right. That's right. Let's dive in a little bit. So we have actually kind of dipped our toes in this area already, but it'd be fascinating to hear from you, because the population that you looked at was so significant and vast. Let's benchmark today's advisor a little bit for those who are listening and watching. What's the average advisor look like today? Average AUM that they're running, number of clients. We've talked about an AUM business model. Are you seeing any trends there? What are some of the things you could glean that might help paint a better picture for folks who are thinking, do I fall into these buckets they're talking about today?
Right. Yeah. Sure. I'll paint a picture on average. Obviously, there's a lot of advisors out there, all with
Yeah.
successful businesses in different areas. The typical advisor, I would say 100 to 150 million. I think in the paper we have 130 million in assets under management. They probably have something in the range of 150 relationships. I'm not saying that's good or bad. I'm just saying that's probably about the average. And one thing that's quite interesting for us monitoring it is we've reached about 50-50 fee. So, and that means that about half the assets are in fee relationships, where you pay per rate on assets. And the other half is in kind of like a brokerage, pay per trade kind of structure. So we've just now, crested the hill, right? And this is a constant change. Like a couple of years ago, I think it was like, a third in fee, I think 5 years ago. So I think this is going to continue to ratchet upwards.
Yeah, actually, and it's a topic we've talked about elsewhere in terms of how advisors manage their book. But one of the things your article mentioned, or the research mentioned, is the need to prune and focus
Mm-hmm.
when it comes to their book of business. Can you elaborate a little bit and maybe connect the dots to some of the demographic challenges you outlined?
Yeah. So we talked already a little bit about, some advisors, they get big enough and they go like, oh, there's a little bit of extra effort to get to that next plateau. Maybe I don't really want to. And this is what it comes down to. If you're an advisor, you started out, you called all your friends who are the same age, and you try to get assets from them, right? You called their grandma, and you called their daughter, you called their niece, you called their dog, you get anybody, right? And you just try to accumulate any assets to start with. As you get larger and larger, you found different clients, new clients, and then you got yourself into somewhere where, hey, I'm running out of time to look for that next client. I just need to spend some time to maintain, right? And every client has some amount of just paperwork and reporting and compliance and all these things that are just never going to go away, that just kind of like adds to that burden, right? And that's what we're talking about. A lot of advisors are in this kind of hamster wheel of, I try to get a new client, but that's just really replaces the old client. And okay, I'll just keep running around, but I'm not really getting a lot of places. This is a bit of a look up from the tall grass. Are all these clients, resonating with your value proposition? Are they in the area that you want to be in? Do they have enough complexity, right? We're talking about, and that's what we're talking about also about robo advisors being this like silver lining here. Like, well, maybe are there some clients where what they maybe helped you start, but you want to focus on maybe going higher net worth. You want to focus on a different niche. Is there an area where you can try to prune some of those clients? Say, you know what, let's find a better channel for you. I just don't feel that I'm able to contribute to the value, right? I think things have changed. There's some new options now. Hey, have you taken a look at some of the directs? And so that you have to shrink your client set a little bit in order to grow upwards, to find time for yourself to grow upwards, right? And that takes real effort, and that takes you to the next plateau.
Got it. And, I'm curious if you've seen any trends in terms of this scale. You mentioned, I think the average advisor uh, having about 150 clients in your data set. Has that changed much over time?
Yeah, I think that fee does add scale a little bit over those, imagine 20 years ago when you had to call every client and say, hey, we should buy Pepsi, sell Coke. And then, that is not scalable, right? Fee is okay. Let's have a conversation about your goals and planning, and that's much more scalable. But over time, we've still seen client numbers of roughly around the same. So although fee has gone up, I think also the complexity of being an advisor has gone up. And so those things are just kind of in competing demands. So I think capacity is still one of the bottlenecks of running your own business.
So that's super interesting. The complexity, we talk about it as the complexity tax that
Yeah.
advisors pay as the business grows. And so it sounds like the implication is that technology to this point has primarily held pace with the complexity gap and maybe helped a little bit of scaling. But I'm curious if anything in the data indicates, if there's an opportunity for technology to limit the need to prune or help people scale, substantially more than they already have.
I would say that to any advisor where you're spending a lot of time, not where your core value is, like just think about outsourcing, and maybe that's another human being and maybe that's technology, but typically that advisor should be focused on planning and communication to clients and maybe looking for referrals and all those other things and maybe high level strategy as well about where the book is going. And why not have some demographics in there too? Not, hey, is that TPS report totally up to date. Like no one's going to add value saying my TPS reports are just like perfect and 100% on time, right? That's just not the thing, right? That's just me dating myself, by the way, there for
I
that
love the
reference.
Office Space reference. If you haven't seen, look, our audience, again, we just talked about, they're financial advisors, right? They're totally getting the Office Space reference. I
There
love
you
it.
go. So yeah, just focus on where your value is, and as best you can, take everything else off the table. Um, and technology and software, I'm a big fan of. So clearly, to use those and leverage those where you can.
You know, as we were talking about this concept of pruning and focusing, to me, the parallels to any other business out there really just jump out, right? When you start a business and you think about an advisor starting his or her business, right? Most of them get their start as especially given the demographic, they got their start when they were stockbrokers, right? And they've evolved into this fee-based model. So that, a lot there's a lot of throwing spaghetti at the wall and see what's stuck type of thing, as you mentioned, right? Just call everybody see if you can get them as a client and so forth. And you end up with somewhat of an unfocused client roster. It wasn't built on what are the clients you have the best strengths at serving. It wasn't the niche that you're most interesting at, or the niche that was most profitable for you, or what have you. And if you talk to any other business owner in any other industry, they'll talk to you about they went through something like that. They were just kind of like, hey, I have an idea. Let's see if it can work. I'm going to just try to get any client in here. John will probably tell you with Blue Leaf, right? The founding story of Blue Leaf, that there's a lot of iterative stuff before you figure out, oh, this is what works, right? Not only is this the best product, but this is the most profitable client segment and so forth. And so it's okay as an advisor or team of advisors to take that same approach. You go, okay, like we got this, but here's where we're really strong, and maybe we should make some adjustments, and maybe we should either let some other clients go or bring in some junior advisors to take them over so I can focus in this area.
Yeah. I mean, to make a statue, you need clay, kind of thing. So you need to like have some clay, and then suddenly you have a mass, and you're like, what do I do with this? And then, if you've got the energy and if you want to get to the next level, it's, oh, I realize I need to, I want to paint this picture. I'm going to carve off a little bit here and there. It's not everything. I'm going to carve off a little bit here and there because it doesn't fit with the rest of the design.
Yeah.
I really like your comment, Kieran, though, about looking up from the tall grass, right?
Yeah.
It at the end of the day, all of these questions can only be addressed if you take your head out of the day to day and ask these more strategic questions. So I think that's really great advice.
Very good. So, most of our conversation today has been talking about some risks, some challenges, imploring advisors to maybe think a little bit differently and so forth. And I know some folks can be like, that's a little bit of a negative, right? So let's talk about, as we wrap towards the end, we come around the corner, kicking for the end, the finish line, as it were. Let's talk about how bright the future looks, right? So, we are coming off or still in a bull market where the market's up 5x since 2009. It's just amazing, right? That we've gone up 5x in that short amount of period of time. But there's been some anxiety during that time, even though people, like I said, they're making free money. They're like, this is awesome. There's an anxiety over fee compression. We talked about how that seems to have stabilized. But one other area, and we've touched on it, I think 2 or 3 times already, was robo advisors. There was a ton, especially over the last 5 years, with some of the popular robos who are, by the way, if you listen to podcasts, you could not ignore some of these robos. They were like advertising on every single podcast out there. But you mentioned that they're not as scary as we initially thought, right? You used a comment, which I loved in our prep call, which is, if robos were a bullet, it might take another decade or 2 for that bullet to find a target to hit, or something of that nature. I'm paraphrasing a little bit. So what if you could dive in about like why were robos a little bit maybe not as scary as we thought, and a little overhyped?
Yeah, so I think, flashback again a couple years ago when suddenly robos were making major waves, were said to disrupt the industry, and a lot of advisors were worried, all my clients are leaving. This is not a price that I can compete on. Like that's just, crazies race to $0, right? I think the primary effect was an attack on advisor confidence. years ago, I'd say like advisor confidence is like all-time low. Like clients are changing, their needs are changing. And now we have robos coming in there and disrupting my value, and I don't even know what my value is anymore. And, I'm just going to price still really low, right? And the reality is different. Robos have grown, but in the segment that, as we discussed, isn't really the segment that financial advisors often target, right? A little bit lower on the financial complexity, lower on the high net worth. They typically are. The robos are targeting, millennials and things like that. And that's why I say, maybe it's going to hit in a decade or two, right? When those clients that are kind of brought up on the robo kind of platform move on over and realize, oh man, I have a lot of questions that a computer is not answering for me. It's not just growth. It's, when can I retire, and what's the kind of down payment that I could put on a house? And I need to look someone in the eye and says, when can I retire? Can I retire at 60? And, I need a human to do that. And I think, financial advisor is always going to have value in that human interaction, that relationship. But initially, advisors were, I think, not thinking about that, just thinking, the carpet is being pulled from underneath them, and I don't know what's going on anymore. But in terms of the actual nuts and bolts, no real impact, I would say. I'm not that bullish on the robos, except for it did get into the minds of advisors.
Interesting. Psyched them out. Well, it's interesting. You saw the fee level, like, near free and super low fees. And, as somebody who's been in the industry since right before the internet became a thing, by the way. So that's how old I am now. You look at some of these robos were talking about how they had $1 billion AUM or 2 billion, and you're like, oh yeah, but at 25 basis points, you're not really making that much money. Like, I know individual RIAs that have more AUM than that, right? And it's going to be, you're not going to be the behemoth that maybe your ads would indicate that you are. And to your point, the level of complexity, as soon as I start having kids who are thinking about college, and I'm married, and I've got parents who are getting a little older, and I'm trying to think about their needs and so forth, like we get into some, I'm going to need to talk to a person, range of things.
Yeah, and what seemed to have happened as a result of robos is less displacing advisors, and really two main things. One, it sort of expanded access to some form of financial advice, right? So that's a net positive. So I think the pie got a little bit bigger if you consider robos to be delivering advice, which, well, that's marginal, right?
Yeah,
but
sure.
But if you think about it that way, maybe. The other thing I think really that it did in terms of where assets might otherwise have gone is, I think it just accelerated the decline of the actively managed mutual fund industry, right? And Vanguard is as much a beneficiary here as anybody, right? It's not just Betterment and Wealthfront. So, from my perspective, it really accelerated an existing long-term trend as opposed to did something dramatic or new.
Yeah, I think that's totally fair. And yeah, there is a benefit here for advisors. There's now more and more clients that are aware of, I can invest, and I liked to be a part of the stock market, and I have some interest in the planning area, but then there could be an opportunity where at some point they get large enough, or maybe even the market goes sideways, and a lot of clients who are in these robos go, wait a minute, my assets just went down as quickly as they went up again. Hold on, what has happened here? Maybe I need to talk to someone. There are some knock-on benefits other than what we've already talked about, which is just thinking as an advisor of the robos are now a channel that you could use to, borrowing a word, augment your business, right?
Yeah. And it's actually we've already seen that. There are lots of advisors who are like, hey, look, I mean, they're kind of using the same AUM model, asset allocation models that we would use in our financial planning software. So great. So I can plug and play into a robo for some stuff, but I can layer on my advice and guidance. And it's fantastic, right? What surprised you most? Or you look at the 2020 report. I love to ask this type of question because we don't often think about it. Like, okay, here's what it is. But like, was there anything as you reviewed the data, you're like, That's surprising. I didn't see that coming.
So yeah, I think it was the client attrition or a complete lack thereof. When we, beginning of 2020, and we're like, oh, okay, there's another down market. Okay, let's figure out our previous playbook. Okay, what happened in 2008? In 2008, client attrition doubled. Okay, it was about like 10% of clients just started moving hands. People were like, oh, I don't like, someone was like, I don't like this line. I'm gonna choose the other line. It's like too bad all the lines are stalled at the same time. And so we were prepared in 2020 to like, okay, every month we're going to report on client attrition and we're going to really harp on it, and didn't happen. It was exactly the same as 2019. There's a complete nope. Everybody was happy. There are, at least two reasons for that potentially. Like one of which is that in 2020 there was also just overall a lot of risk aversion. Every client wanted to just stay still. Every relationship was like, I just want to not do anything here. I just want to, hunker down, and I don't even want to move anything. I don't want to move jobs. I don't want to move advisors. And maybe that will change going forward. But the other one is that the industry has changed in a decade, right? 2008, majority was transactional, was brokerage, was, hey, call me when you need a trade, or I'll call you when I think you should have a trade. And now it's much more about that relationship. That's much stickier, right? It's and that trust and that transparency where advisors are really getting it now. I mean, that obviously leads to a lot more fruitful relationships that hang around for long term.
When you think about, what you learned in the 2020 data and really all of your historical data, and you think about the trends and some of the really unfinished stories, looking forward to 2021 and maybe even beyond, what are you most interested to see develop and how things are going to turn out?
So one thing that we talked about a little bit in the paper is like this rise of the hybrid household. What I mean there is a client that has both a brokerage and a fee account. And we see in a lot of the high net worth space, it's a lot of fee addition. It's not fee transition. It's not like take your entire brokerage and move it over. It's augment with an advisory piece. And I think it's now more than half of million plus clients are both these hybrid type of relationships. And that's putting a lot of strain around original thinking or around pricing, which is all product level. It's like, okay, you pay per trade, brokerage, done. Oh, what's the fee account? Okay, done. Well, I mean, if I'm a client and I have two accounts, I really do not care about how each individual account is priced. What I care about is how I'm priced overall. And that's not really how the system works right now. And if I don't like my fee, well, maybe I'll just take more of my money over to the brokerage side. These are things you can do. And I just don't think as an industry, we're just starting to think about that. And I think what we're talking to our clients about is, well, maybe we should just have a relationship price. Let's forget, this is again the long-term evolution of it, right? Before it was like, what's our value? Oh, is it a trade? Okay, we'll pay per trade. What's our value? Okay, it's some advice on these assets. Okay, fine. But you're hard pressed to say that someone with $1 million in brokerage and $1 million in fee is getting different and worse advice than $2 million in fee, right? Like, really? Because they're getting a different rate, right? So, okay, how do we package it up and say, I don't really care what type of fee account you're in or even how much is in brokerage. What I care about is the overall relationship. And that should be priced in a certain way around the value you get. So that requires a lot of thinking, and we're trying to move clients towards that. And that's something I'm really interested in seeing how that plays out going forward.
And there seems to be a similar evolution in the advisor business models, right? Because this really mirrors the rise in hybrid advisory practices, and it seems like this is an issue that's particularly tricky for businesses that are transitioning from primarily a brokerage driven model to more of a fee model. And that was really the whole industry, as you pointed out, about 10 years ago. So It's it'll be fascinating.
Yeah, it's like on the one hand, you have these advisors that are moving from brokerage to fee, and then you would hope that the clients would kind of go with that, but no, they're straddling the line too. And so I think everyone has to kind of recalculate, rethink. When every client has both options, like what does that mean for your business? How do you price it effectively? Where's your value? Again, but it's all about that relationship level.
Yeah, and it's interesting because, to paraphrase, the future is here. It's just not evenly distributed.
Mhm.
And
Yeah.
certainly we see advisors in our business that are already doing relationship pricing
Yeah.
to the entire household, and they're already making that work. But interestingly, most of them are smaller and mid-sized firms. We haven't seen any firm at scale embrace that, and I think that's really the interesting and tricky part of that. How would you do that if you've got 5,000 advisors and you need to make a policy? That's a set of interesting questions.
Yeah, that's all about the product shelf, and it's all about you need to develop help your advisors out, right? Because with the products having their own pricing, that doesn't lend itself to relationship level. So you do have to start thinking about, do we need to develop a new product that kind of all encompasses this type of it? Maybe a unified account structure that does that. And these gears are turning. It's slow, and
Sure.
and so obviously those firms that are a bit more nimble can do it a little earlier than those ones that are a bit larger.
And the part of that we're thinking a lot about at Blue Leaf is actually the part about how do you actually service those assets, right?
Yeah.
Because not all of them may be with your firm, right? If you think about the 50-year-old client that we need to embrace as an industry, well, you've got 401ks spread around, right? And how do you advise and price on those? You need a platform that actually enables the services. So that's another part of the equation, I think, in addition to the pricing. That's going to be interesting to see how that evolves.
Yeah, absolutely.
Love it. So, Kieran, I got to tell you, I think you're going to be an annual guest on this show, because it'd be fantastic every year to have you back to talk about the state of the North American retail wealth management space, because it'll be really neat to kind of see how this evolves, right? The old Bill Gates saying that, people always overestimate the amount of change that happens in 2 years, but grossly underestimate how much will change in a decade. So it'd be wild to kind of watch how things change. Well, it's been a pleasure having you on the show, sir. Thank you very much. You were very generous with your time. This was fantastic.
It's been great. Thank you so much for having me.
Really appreciate it, Kieran.
No worries. Enjoy your Letterkenny.
Pitter patter. Let's get at it. Thank you very much for listening to this episode of the Augmented Advisor podcast. It was fantastic to have you with us. I hope you enjoyed this conversation as much as we did. Huge thanks to Kieran Bol from PriceMetrix by McKinsey as well for joining us. He brought the thunder with some really high impact, actionable insights. Make sure you swing by blueleaf.com for a link to the report so you can dive in a little deeper on the concepts we covered today. As I mentioned at the top of the show, please make sure you subscribe to the podcast on your favorite podcast platform. And do us a favor, make sure you give the Blue Leaf page on LinkedIn a healthy follow. Smash that follow button, okay? We share every episode of this show on LinkedIn, and we would love to have you be a part of our community, okay? We want to hear from you. So follow the page and comment along as you see fit, okay? All right, that's it for today. Please make sure you're staying safe and be nice to each other. We'll see you next time on the Augmented Advisor podcast. See ya. Bye.